Hey traders, this is Blake Morrow with Trader Summit, and with me today I have Mr. Ken Morrison from Morrison on the Markets. How are you, Ken? Good to see you.
I'm terrific, and thanks for having me again, Blake. I can't really remember when we were last on here talking, but I think it was the end of August, but that seems like a long time ago.
Yeah, I think it was actually before that, and but it was definitely before the new year. And so, happy New Year to you. I know you just got back off of a big trip, and you went to Australia. So, what did you learn when you went to Australia about the global economy?
Well, we learned a little bit, I think. Colleen and I were gone for 2 weeks, about 2 weeks. We'd not been to Australia since 2006, but prior to that, while we lived in Asia, we traveled to Australia quite frequently. We stayed with friends that we met and were neighbors of in Shanghai. They are Australians that now live in Melbourne. Take on the economy from an Australian perspective. Interestingly enough, I didn't know this, but apparently the home mortgage market in Australia is largely based on adjustable rate mortgages. The notion of 30-year fixed mortgages is not something that is used hardly at all in Australia, which I didn't know. But I guess the narrative in the economic section of the newspapers are all talking about the big surge in global interest rates and how that's going to adversely affect the Australian economy as homeowners have to reset their mortgages. And I do recall, I can't recall specifics, but I do recall the general nature of the economic data in Australia was already showing, and this was mid-January, was already showing some, some effect on consumer spending, so on and so forth. So that's the narrative side of the economy in Australia. But what you observe is similar to what I've observed here in the US, and that is if you try to get a booking in a restaurant, even during the middle of the week, you better call a few days in advance because everything is booked. We went to the Australian Open tennis tournament 2 days during the first week of the 2-week tournament. And on Saturday, the first Saturday of the tournament, they recorded a record attendance at the Australian Open tennis tournament. So my takeaway on the Australian economy is quite similar to what my takeaway is on the US. There are a lot of mixed signals when it comes to the economy and perhaps the consumers' perception of the economy versus what their behavior in the economy is doing. And if I judged it on the basis of the behavior in Australia and the US, the economy seems to be going quite well. Thank you very much.
Well, it's interesting because you're a commodities trader and you were just visiting a commodities based really economy. Did you have any takeaways regarding that sector of the country's industry?
Other than a big headline on the first day that I arrived in Melbourne, the headline in the business section of the national paper was talking about their expectations for a record cotton crop that happened to be a record crop despite the heavy flooding and rain that they've had during planting time. And so that was the only real strong takeaway from a commodity point of view. Our travel through Tasmania. Tasmania is a state of Australia with 500,000 people and 2.5 million sheep. So we did see on our drive through the countryside a lot more sheep than cattle than people. So it's largely an agricultural economy in Tasmania. And another interesting point, I guess, is Tasmania it has a reputation of supplying the rest of Australia with a lot of its fruits and vegetables. So it is a primary agricultural region, and primarily, I guess one could say, for the consumer as opposed for the commodity markets, if you will.
Well, Ken, that's really interesting, and it's nice to have you back, and I'm sure it's nice to be back in your own home. at this point. But how about the markets that you trade? I know you brought us a couple of charts, but how are you feeling about the current state of where we're at right now? We've had a kind of a rebalance over the 2022 year of equities. And, we saw a steep sell-off, the market recovered, we're near 4,000, kind of, I would almost call it a mid-range of our 2022 range. How's the commodity markets looking to you, just from, a big, just kind of an overall view of the commodities markets?
I'm going to start with a commodity that's really not a listed commodity, and that's ocean shipping rates. The BDI, the Baltic Dry
Index,
Freight Index,
yeah,
is the lowest level it's been since June of 2020, or 2020. And that typically is a reflection of the demand for commodities, or the lack of, in this case, the lack of demand for commodities. Rates have fallen literally at a 45-degree angle off their peak, and they really are kind of finding trouble finding a support here.
With you saying that, the BDI, that's something that I haven't heard in a while, but I look at you, Ken, as one of the, one of the early warning indicators that maybe us as traders globally, whether we're trading currencies, whether we're trading equities, that's a pretty stark warning when you see the BDI just kind of fall off the map, right?
I think I would emphasize, though, Blake, that the BDI is a reflection of two major commodity groups, one being iron ore and coal. And so I look at the BDI and its decline, if you will, as a statement about it's a loud message for those who believe that China is going to have a quick recovery from lifting its restrictions. And so I would start there in terms of emphasizing the BDI is a reflection of the recent, past, and current outlook on iron ore and coal demand for China. But it's also a reflection of the global grain demand, I believe. And so is it a warning of the future, or is it simply a cautionary tale that recovery? China is either number one or number two in just about any globally traded commodity that you want to name. And so we have to be careful not to assume that the past will be like the future in terms of ocean freight. All I'm going to say, though, is don't get too excited about the recovery in China, because the ocean freight market is telling you it's going to be a slow process.
And looking at the chart that you brought to our attention, that is not the prettiest looking chart from left to right, unless you happen to be short the index, which it's not really what you do, a non-tradable index. But it's worth noting. What else did that has your attention as well?
Crude oil, of course. The last time we spoke, I remember my downside target, or downside support, if you will, was probably closer to the $85 level in crude. And I do believe that was without even looking at a chart, I think that was probably back in the August, early September timeframe. And I said, though, that at the time, that if I see a deterioration in crack spreads and crack margins, refining margins, my view about crude oil would not be as optimistic as I was at that point in time. And that's exactly what we've seen, which chart, don't move to it yet, but a chart on the spread between diesel and gasoline as an example, and its effect on the crack spread has done. Now, the one thing I want to point out from a very recent near-term situation in crude oil, what I really have found interesting about the recent price action in crude oil is that from the $81 price level on, I think, January 26th to the low earlier this week of about 73, open interest was up an astounding 120,000 contracts. Now,
That's crazy. Wow.
that can only tell you that it was the dominance of new short sellers that was driving price lower. It was not long liquidation. So unfortunately, we have not seen a CFTC position of traders report for now almost 2 weeks. So I can't really say if that was commercially led or fund led, but I just found that extremely interesting. And I would go on to say, in fact, this was my call a couple of days ago, is that given that preponderance of short selling recently and the price declined from 81 to 73, it was my view that we were going to get exactly the bounce that we've had over the last day or two. And that is, the market was primed for a short covering rally. The dollar looked like it was going to stabilize, at least, if not back off a little bit from its 3-day rally. But I also believe that the bounce, I'm going to call it a bounce, a short covering bounce, I do believe that the crude oil rally has gone just about as far as it's probably going to go in the very short term.
So in the very short term, it looks like, based on your chart, even though we had that little false breakdown earlier this week, looks like you think that we're going to find some resistance around the $79-80 level, roughly.
Yeah.
Okay.
You know, if this market can cross 79 or 80 on a closing basis and hold that for a day or so, okay, maybe we can talk about 82, challenging 82 resistance once again. Yeah. But that's where I'm at right now. You got to prove it to me, because I think the market was just set up for a very short term, short covering bounce, and that's pretty much what we've had.
All right. Well, the next chart you brought is the heating oil gasoline futures spread. What do you, and the crack spread, which might mean different things to different people, but that's a joke. I don't know if anybody got that. Anyway, Ken, what do you see in this chart?
Well, I see, again, we're building stocks. In fact, the report today said gasoline and diesel fuel stocks are the highest, I wrote it down, since March and February of 2022. So we are rebuilding inventories in gasoline and diesel. And as a result, this decline in the value of heating oil, which is really diesel, the value of diesel relative to gasoline has literally collapsed since the middle of January. And so with that collapse, therefore, you've got crack spreads that are going to decline as well. So crack spreads have come down since January 23rd, about $7 a barrel, which is one of the reasons that crude oil had to back away as well.
So if the spread starts to bounce from here, what's that going to tell you about the markets?
First of all, I guess I again would look at this chart and say, I don't expect we're going to recover back to the levels of even 26 to 26 and above in terms of this spread. So I wouldn't get too alarmed unless that were to occur. But it just, it just kind of tells me that supply is finally catching up with demand. Demand has frankly been a little bit soft. So that's one of the reasons that it's catching up. I mean, gasoline supplies today were up 5 million barrels week over week. Distillate supplies were up 3 million barrels week over week. And I think crude was up like 5 million barrels. So, we saw a pretty good back. In fact, the products went from positive to negative on this morning's EIA inventory report. So I think I think the energy market is still fighting an uphill battle.
All right.
Yep.
All right. Well, that's okay. That's good to know. So the next chart you brought, you want to talk about meat, and I, so it scares me a little bit as I'd say I'm a proud non-vegetarian and vegan. What does this chart tell you, or us?
Well, first of all, I would venture to guess I'm probably the only person you've ever had on that talked about the cattle and beef market. Am I wrong about that?
You might be. This is a true statement, actually, now that I'm thinking back. Yeah.
I think in terms of the general public, you get outside of the interested parties trading agricultural commodities, especially the livestock markets. I think this story, Blake, is probably one of the most underappreciated stories in commodities right now. And that's, I don't think I'm exaggerating my thoughts on that. And I'll talk about that a little bit, why. But all this translates to, when you've got the 50-year low in the beef cow industry in the US, and if you consider, and one of the reasons that that's occurred is that dryness, the lack of pasture and forage in especially the southwest part of the US, where a lot of the cattle is either grazed and or on feed, the drought has simply diminished pastures such that producers have been marketing more of their, if you will, feeder stock, calves and feeder stock, than is typically the case. Typically, the percentage or the proportion of heifers that go on feedlot operations is roughly about 32% of all cattle put on feed. Well, we've gotten to 40 and 40+% heifers that are put on feed. So if we think about the beef cow industry, that's your manufacturing plant. If we think about the replacement heifers required to produce future feeder cattle to go into that feedlot, that's your raw material. And so if you're marketing and selling more heifers and more females for slaughter than you typically do, and you're not only diminishing the current beef cow inventory, but you're diminishing those female heifers that will eventually become and replace those beef cows to produce your beef. And so,
did you want me to advance to the next screen? Because I think that's the important one, right? Okay.
Exactly. So this is the total. The USDA doesn't break out the calf crop, if you will, annual calf crop by type, beef versus dairy. So this 34 million head produced in 2022 is all cattle. However, simply based on not only the trend in the beef cow industry, but the trend in the replacement heifers that eventually, after 2 years, will produce a calf if retained and not sent to feedlots. The projection for 2023 calf crop is that little star down there, which is also below the 2013-2014 low.
Wow.
So again, it takes about 40 months by the time a calf is born to go to slaughter. And so you're looking at a minimum. If producers today started retaining more female calves for future breeding, it would still be a 2 or 3 year process to start to rebuild the number of beef cattle that we slaughter in the U.S.
And I got to mention, just because you were talking about the Southwest, we've been, here in the Southwest, we have been plagued with a lot of rain and inclement weather that will improve these conditions, but you're still talking about a 2 year lag time, right?
That's right. And also I would point out that the majority of the beef is in West Texas, Southwest Kansas, and those are areas that still have missed those rains that Arizona, as an example, have been benefiting from. So, but you're absolutely right. It's a 2 or 3 year process, even if it began today. And without rebuilding pastures and forage, you can't be optimistic that the process or that the trend of declining females for future breeding is going to turn around anytime soon. So, yeah.
So what does that mean for prices? Because all I can think about right now is the old Chick-fil-A commercial for those of us in the United States. It says, "Got chicken?"
Yeah, that's right. This pretty well tells the story of not only how the marketplace is viewing the supply of beef going into this is basically present day.
Yeah.
This futures market represents cattle that's marketable today. the unfortunate thing about, I guess, risk management in the livestock industry is that there are no listed futures beyond about 1 year. So, institutional food processors, as an example, and fast food restaurants and so on and so forth, if they want to go out and, if you will, cover some risk of the future 2 or 3 years of their beef supply, they've got to do that through private negotiation. But this futures market in cattle, I think, will eventually exceed the highs that we saw in 2015. And by the way, the trend that resulted in those high cattle prices in 2015 was very much a result of the same conditions that we have today. Lack of forage, lack of pasture, and so a depletion of the cattle supply, simply because there was not enough feed to feed them.
So I guess what you're saying here is we really have to prepare for higher beef prices in the coming years, is what it seems like.
That's right. And what I see developing here is chicken production, which has a much faster growing cycle, if you will. Chicken production is already going to be taking some of that deficit beef supply and offsetting that. So we're going to see we're already seeing additional chicken supply on the marketplace. But the interesting part is pork producers certainly are not expanding herds, and they have also been through about a 3-year cycle of depleting their inventory as well. And that is mostly a function of high high grain prices. And so there's no evidence today to suggest that the U.S. pork supply is going to begin trending higher again either. So the way I see this unfolding is it's bearish on per capita beef consumption. In fact, there's many places in the world that's we're already seeing that. I mean, Brazil is probably the largest per capita consumer of beef in the world, and even in Brazil, the per capita consumption has been in decline. So beef is going to price itself out of some consumers' diets. They're going to replace that with probably chicken and perhaps some pork. So the effect on future consumer taste in terms of their meat protein, I think, is going to permanently be altered for a while. But yeah, from a consumer standpoint and inflation standpoint, beef is going to be it's going to trend higher. I don't know of anybody that can make a different case unless you were just super bearish on the global economy or something like that.
Well, with that being said, I'm just going to say this: if you guys and gals like what Ken has to offer here, I think all of us are just become educated even more by listening to you, Ken, and your take on the markets. Make sure you jump in the comments, give him a big thumbs up for these exclusive interviews here on Traders Summit. And I want to say also, a big portion of our viewership happens to be in North America, in the United States, and the most popular television show right now is Yellowstone. So at least when you're having conversations with your friends about Yellowstone, you're going to sound more educated about beef, herds, and cattle, and life expectancy of cattle. So thanks, Ken. I appreciate that.
I've told them just enough to be dangerous, Blake.
Well, Ken, I really, truly appreciate you being here. Tell us a little bit about how we follow your work, because you are really a in my opinion, and you have been for almost probably 13, 14 years, in my view, a leader in the commodity space. How do people follow your work?
Well, I write a daily newsletter, morrisononthemarkets.com, and 4 days a week, Monday through Thursday, and then I put out a weekend edition. I cover, in every edition, I probably cover a minimum of 10 or 12 different commodities. My primary emphasis and experience going back, to 1976 is primarily in the agricultural space, but I do, of course, follow the energy markets quite closely, because they're, basically very intertwined with agriculture now. So
sure. And as traders, we gotta keep our hands in different pots at all times, right?
Right. That's right.
Well, Ken, thank you so much for your time. I appreciate it here. I know the Trader Summit community really appreciates it. I can't wait for our next conversation, and I'm gonna go stock up on beef right now.
There you go.
Have a great day.
Okay, see you. Thank you, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.